We have looked at depreciating plant assets, those assets that are used in the operation of our business. But there are other types of long-term assets that we must also allocate cost over the benefited periods. These assets include natural resources and intangibles. A natural resource is an asset that we derive from the earth and can only be replenished or recreated by an act of nature. So, for example, timber. Timber can only be created through an act of nature. The tree must grow. Coal can only be produced in the earth, by the earth, actual coal. So things that we pull from the earth, we extract from the earth, we derive them from the earth. However, only the earth can replenish them. In other words, only an act of nature can actually replenish those. Those are natural resources, and things that fit in that category would be timber and oil, coal, diamonds, anything that we're extracting, granite from the earth. Then the next thing is intangibles. Intangibles are assets that actually lack a physical substance. Typically, these types of assets grant the right to. So in other words, you have the right to produce, or you have the right to own certain copyrighted material, or you have the right to use a trade name or a trademark, or for example, McDonald's, you have the right to put the McDonald's logo and sell a Big Mac. You have to own an intangible asset in order to do that. So when we allocate costs for plant assets, we call them depreciation. But for natural resources, we call it depletion. And then when we get to intangibles, we call that amortization. So please keep that in mind. We depreciate plant assets, we deplete natural resources, and then we amortize our intangibles. So let's look at an example of depletion. Parker Company purchased a coal mine on February 1st, 2013. The total price of the mine was $800,000. At the end of the life, the mine will have no value. The mine is expected to produce 2 million tons of uniform grade coal. In 2013, the company mined and sold 250,000 tons of coal. Record the purchase of the mine on February 1st, 2013, and any required adjusting entry at the end of 2013. So let's start by recording that initial purchase. We purchased this mine on February 1st, 2013. We're purchasing an asset, so we're just going to call it mine, or you could call it coal mine. Let's put coal mine just for the fun. It is a natural resource and asset there. And the coal mine, its goal is to produce coal. And we paid $800,000 for that mine. Now, it doesn't tell us how we paid, but since it gives us no accounting, we would do cash. So we would reduce our cash by $800,000. So now we own this mine. We need to go in and we need to extract the coal. So December of 2013, we need to go in and see, okay, how much coal have we extracted and how much coal have we sold? In this example, we extracted and sold 250,000 tons of coal. Well, when we deplete, it's very much like depreciation expense. The first thing we do is we're going to debit the expense. And in this case, it's not depreciation. We call it depletion. And then we're going to hit accumulated depletion. Now, some companies will hit it straight against the coal mine. So depletion, you can either have a contra account called accumulated depletion, or you could offset it straight into the coal mine and reduce the value of the coal mine either way. For our purposes, we're going to use accumulated depletion. Now, the next question is how much? Well, depletion is very, very much like units of activity when it comes to calculating the depletion. What you end up doing is basically taking the cost of the asset, you subtract out the salvage or residual value of that asset, and then you divide that over the useful life in units. And another way to say that is our estimated units, the estimated number of units we expect to extract. And in this case, it would be tons of coal. So for this, we would simply take the 800,000. Now, there is no residual value. There would only be residual value if you own the land, not just the mine. So the residual value is nil unless you truly own the land that it sits on. Sometimes you do, sometimes you don't. In this case, we don't. We only own the coal mine itself, what's in there until we extract the coal. And we're going to divide that by the number of units, and we're going to get, or expect to get, 2 million units of coal, 2 million tons of coal. out of this mine. So 800,000 divided by the 2 million, and that gives us 0.4. So that's 0.4 in expense per ton. Now what we need to do with that is multiply it by 250,000 because that's the amount that we have mined and sold. So when you take 250,000 times zero point 0.4, you come up with 100,000. So we get to expense 100,000 for this mine because we both mined and sold those units. Okay? All right, now let's look at 2014. Well, in 2014, we did the same thing. However, we mined 300,000 tons of coal. Now, in this case, though, 250,000 tons were sold. So record any necessary adjusting entries at the end of 2014. All right, so we definitely need to do an adjusting entry. The first thing we need to do is calculate to see how much. So how would we calculate that? Well, again, we already know that it's 0.4 per ton. So we just need to take that and we need to multiply it by 300,000 tons. That's going to tell you the amount of depletion for the period. So 0.4 times 300,000 gives us 120,000 in depletion. Now, here's the problem with that. Yes, we need to deplete, which means we need to reduce the amount of the mine by that amount. So we definitely need to hit accumulated depletion for the actual 120,000. That's a given. We definitely have to do that. However, since we only sold 250, we can only expense the amount we sold. Remember, we recognize expenses in the same time period they generated revenues. Well, 300,000 didn't generate revenues this period. Only 250,000 tons generated revenue. So we need to take the 250,000 times the 0.4 and again get 100,000. So since that's the amount we actually sold, that's the amount we get to deplete. So we're going to hit depletion expense and we're going to hit it for 100,000. Now on the offside though, what do we do with the remaining units? Remember, 50,000 of those units are still sitting there. They're no longer in the earth. They've been extracted, so the mine no longer has those, but we didn't sell them, so we can't actually expense them. So we're going to take that 50,000 times 0.4, and that gives us 20,000. What are we going to do with that 20,000? Well, those items are held for sale, and when we hold items for sale, we call that inventory. So this is going to be part of our inventory for the end of the period. All right, very good. So let me know if you have any questions on our depletion. But for now, let's move on and look at intangibles. Several intangible assets exist. So let's talk about a few examples. One is a patent, and a patent gives us the exclusive right, and it's issued by the government that allows us to produce in a certain way or to control an invention. And patents last about 20 years. Copyrights are also issued by the government. It gives us the right to produce and sell artistic or published works. So written word would be a copyright. These last the entire life of the author plus 70 years. So if you have a copyright, that copyright lasts until you pass, plus 70 years on top of that before the copyright expires. A franchise is a contract. It's an intangible asset. It's just a contract that gives you the right to use a trade name or sell a certain product. For example, a franchise of McDonald's, it gives them the right to sell McDonald's goods, a Big Mac, a McMuffin, and it also gives them the right to use the golden arches of McDonald's, their trademark. And then Goodwill. Now Goodwill is another example, but it's slightly different from all the others. Goodwill is not charity, and it's definitely not because the company gives to charity. Goodwill exists only when one company purchases another company. And in that case, when that company buys the other company, because of the company's reputation, which could be, great employees, wonderful customer service base, certain technology, just different things, we may be willing to pay a higher price of that company than its actual worth, its actual net assets, which are the assets of the company minus their liabilities. So if we decide, to pay more for the company than its net worth, its net assets, then we have to record that as goodwill. It's what you paid above and beyond the company. Now, one thing to keep in mind, goodwill is never amortized. It has indefinite life. It could go on for eternity, so to speak. So we definitely do not amortize goodwill. However, we do impair it. So if it becomes impaired, we will record an impairment loss. Now, impairment is definitely beyond the scope of a general principles class, so we will not be discussing impairment. So let's just look at a normal amortization of a patent or of an intangible. So patents, copyrights, all those are amortized over their useful life. So Parker Company purchased a patent on April 1st, 2013 for $100,000. The patent has a useful life of 5 years. Record the April 1st purchase and any necessary adjusting entry at the end of the year for this patent. So April 1st, 2013, we're going to record the patent. We purchased the patent. We purchased it for, let's see, $100,000. Now, when it comes to an intangible, you amortize the intangible over either their legal life or their useful life, whichever is shorter. So when we do this, we're going to credit our cash for $100,000. When we do this, you have to remember a patent has a 5-year useful life in this case, but it has a 20-year legal life. Since it has a 5-year useful life, that is the shorter period. Therefore, we are going to amortize it over 5 years. So now that we know that we have to do it over 5-year useful life, let's figure out how to calculate it. Typically, we amortize intangibles straight line method. So you simply take the cost of the intangible, you divide it by its useful life. So in this case, we paid $100,000 for that patent. We're going to divide that by its 5-year useful life, and we're going to get $20,000 per year. Now again, that is $20,000 per year. Now in this case, remember we only purchased it on April 1st. So since it was purchased on April 1st, we're going to have to prorate it. So we need to prorate it for 9 months, the actual number of months we held it. Had we purchased it on January 1st, we would record 20. But since we purchased this on April, we're only going to record 9. So 20,000 times our 9 over 12 gives us 15,000. So for the patent, we get to amortize 15,000 for 2013. We call that amortization expense. So we're going to debit our amortization expense for the 15,000. Then we're going to credit, and patents do not have accumulated amortization. It goes straight against the asset itself. So we're going to actually reduce the value of the patent by 15,000.